Assalamu alaikum. Welcome to lecture 40 of SBR, which is analysis and interpretation. This is unique from the other previous 39 lectures. Why? Because this is not about a particular standard, but generally overall how you analyze statement of financial position or statement of cash flow and what uses you get from it. How do you interpret the numbers basically? And you are definitely going to get this most in question number 3 or 4 of your SBR, right? You are going to get every year a question is asked on this. So let's do this. Here we are going to go through this areas. We are starting with financial ratio. Okay, it is expected of you that you should know all these ratios. You should know the formula, memorize the formulas, because in your SBR exam, in the formula sheet, the formulas will not be given to you. You need to know it. Why? Because when you came to SBR, it was assumed that you know all the financial ratios from your financial reporting. Okay, so you have to know it. Even if in SBR they don't teach you separately. That's why I've included it here as the first topic. Next, what are the impact of policies and estimates? We all know the standards have their policies and estimates. What are the impact of it? You have to know it. Then the usefulness of the statement of cash flow. Some additional performance measure. Tech companies. How do you value tech companies? Non-financial performance measures. And finally, we are going to end it with integrated reporting. Starting with financial ratio. There are so many ratios that we are going to go through right now. Okay. The first ones are the major ones. Okay. Profitability. So under profitability ratios, even ratios are classified by the way. We have profitability, we have liquidity, we have investor ratios. Okay. We have efficiency ratios. So under profitability, we have gross profit margin. Gross profit margin is gross profit divided by revenue into 100%. Okay. Usually increasing ratios are good in terms of profitability, because okay, so an increase in gross profit could be a result of higher selling price or lower purchasing price. Maybe you are buying something in bulk, so you're going to get a heavy discount. Okay, so that is the interpretation. In your exam, if you are given ratios, you might sometimes have to calculate here and there. You might have to calculate ratios. Even if you're not, you should at least know how to interpret the ratios given to you. Okay, why something is high or why some ratio is low, and what is the impact? Is it good or bad for the company? You should be able to read it. Okay, basically you should be able to read the numbers and explain to the people who have non-finance background. That's the whole purpose. Now coming to second ratio, that is operating profit margin. It's the same, but just change the gross profit with operating profit. Here also higher the better. Higher operating profit margin means you are better able to control expenses. Why? Because operating profit means simply gross profit minus expenses. Okay. Third ratio, that is under profitability, return on capital employed. I'm going a little faster because I'm assuming you know all this. This is just a revision of your financial reporting, I would say, or any other papers that you have done where you have ratios. Okay. Operating profit divided by capital employed. This is also higher, the better. Okay. That capital employed part, you can include your equity plus debt. I mean, any interest bearing finance, basically debt, like your long term liabilities and all. Now, ROCE measures how efficiently an entity is using its resources. Okay, this you have to compare this. Okay, it should be compared to previous year, the target ROCE, the competitor, and the cost of borrowing. Then only you can tell whether it's good or bad. Moving to liquidity and working capital. This is the second set of ratios. First was profitability. Under that, we went through three ratios: gross profit, operating profit margin, and ROCE. Now we are moving on to second type of ratios, that is liquidity ratio. Under liquidity, we have two ratios: current ratio, asset test ratio. Current ratio is current assets divided by current liabilities is to 1. So basically, this means how efficient or how sufficiently you can cover your current liabilities with your current assets, or how are you able to manage your debt in the short term. The higher the ratio, the better it is. Why? That means you're more secure financially. But too high a ratio is also not good. That means you're tying up or you're using your working capital inefficiently. You're not managing it well. You are holding too much of stock or having too much of cash without investing it somewhere else, right? So that is also not good. Usually the ideal ratio is 2:1. okay, or 3 is to 1, or 1.5 is to 1. But anything more than that is also not good. Less than 1 is also not good. 1 is to 1 is also good, but it's better to have a little more so that you can have some savings for the bad time, rather than having 1 is to 1. Even 1 is to 1 is not bad, it's good. But having less than 1, where it becomes 0.7 is to 1 or 0.5 is to 1 is not good. Why? It means you are having less asset than your liabilities. 1 is the liability, remember. After that, whatever ratios you get, that is your current assets. Okay. Moving on to second ratio, that is inventory turnover period. This also comes under your liquidity ratio. The formula is inventories divided by cost of sales into 365 days. High turnover ratio is not good. Why? It suggests two things. Customers are not demanding your goods and poor inventory control. Now moving on to receivable collection period. Trade receivable divided by credit sales. Only credit sales, okay? Because receivable comes from credit sales. You cannot include your cash sales here. Be very careful what you are putting in that formula, okay? Into 365 days. So here, higher the ratio, that means higher the receivable collection period, it's not a good sign. Why? That means your customers are delaying in paying you. That's why receivable is increasing. Rather, your receivable should be shorter. It's good for you. That means more cash is coming in. Why it could be? That means there's a poor lack of credit control. You're not able to control your credit customer, which is not good. Because this can lead to irrecoverable debts later on, which is an expense. Second, payable payment period. It is trade payable divided by credit purchase into 365 days. Okay. This also long period is good in a way because it helps you to have some source of finance, some source of cash for a few days without paying it to your creditor. But over a long period of time, taking too much of time to pay your supply is not good. Why? Because later on your suppliers might cut out that credit facilities from you. Okay. It might lead to a damage of reputation and your credit worthiness might go down. So yeah. Now, next set of ratio that is known as long-term financial stability. Those were short-term liquidity ratios. Now this is long-term financial stability. Under this we have gearing ratio. Gearing could be debt divided by equity or debt divided by debt plus equity. You can use any formula. Okay. Gearing, high gearing is also not good because gearing is attached to risk. Higher the gearing, higher the finance risk. Okay. And highly geared entities have a greater risk of insolvency also. They could be very easily, they're insolvent. Okay. Just not good. Next, we have under the same long-term financial stability interest cover. Formula is operating profit divided by interest finance cost. Sorry. This interest cover shows with your profit how much you are able to pay your interest. Okay. Higher the cover, better it is. But lower the cover, not good. Why? That means you are having difficulty in paying your interest with the fall in profit. If your profit falls, will you be able to finance your debt? Will you be able to pay the interest? It becomes very difficult. Low interest cover shows that. Now, PE ratio. This comes under investor ratios. Investors are more concerned about this ratio. Price earning ratio. Formula is current share price divided by EPS, earnings per share. This ratio, higher the ratio, better it is. Why? Because it shows a positive view for the future. Okay, that means it shows a positive future prospect of the entity's share. Higher, the better it is. That means growth is expected. So now let's do a small question. That's it. We have covered all the ratios before we move on to the impact of policies and estimates. Test your understanding 1. Stalling. Okay. Here you have to discuss the impact on the financial statement of the above error. And your answer should make reference to the ratios. Okay. So let's start. Starling has issued B class shares and has recorded them as equity instruments in the statement of financial position. Okay. Under the terms shareholder agreement, Starling is obliged to redeem the shares in cash in 3 years' time. Okay, they have an obligation to redeem the shares in cash in 3 years' time. Okay, now which standard deals with it? Before you go to ratios, you need to understand the particular standard dealing with the issue in the question. Otherwise, you will not be able to solve any question. even though it's ratios. Okay, it comes under analysis and interpretation, ratios. But before applying ratios, you have to know. So equity instrument, okay, comes under IFRS 9. First, you need to identify this. In your mind, it should click that this is from IFRS 9. So according to IFRS 9, okay, which topic is this question asking you? It is the classification into equity. It should be equity or liability. Even though they didn't mention the word liability, but through the word that they have an obligation, through this word, obliged, they are telling you that whether it should be equity, whether it is correct to classify it as equity or should it be liability. This is what the particular question is directing you towards it. See, IFRS 9 is a big standard. It has so many parts: derivatives, embedded derivatives, cash flow hedge, fair value hedge, right? Then it has financial assets, financial liabilities, equity instruments, then financial asset impairment. So it has so many small topics in it. But this topic is specifically touching on the classification of equity or liability. That's what it is touching about. So your answer have to be specifically focusing on this part only. That's it. Should not go beyond this. Okay. So you tell me whether it's correct that they have classified it as equity or should it be financial liability. Read the last line carefully again. Starling is obliged to redeem the shares in cash in 3 years' time. In cash. That means they have to convert the shares into cash in 3 years' time, and it's an obligation. So whenever the word obliged, obligation is there, it is a liability according to IFRS 9. It's a financial liability. And by the way, this classification of financial asset and financial liability, sorry, financial liability and financial equity falls under IS 32. Okay, this is another topic under financial instrument only, but it only deals with the classification of equity and liability. Okay, whether you present it as equity or liability, that's what it is about. Because there are three standards which deals with financial instruments: IFRS 7, which is about disclosure; IS 32, which is about classification; and IFRS 9, measurement, recognition, and the main thing. Okay, so liability, okay, it should be classified as a liability. Why? They have an obligation to transfer cash. So the word should be obligation to transfer cash. So this instrument should be classified as a financial liability. Why? Obligation to transfer cash. You have to write this in your answer. Obviously, you cannot draw diagrams in your exam. You have to write in proper sentences that this instrument has to be classified to a financial liability because it has an obligation to transfer cash. I am showing you in a way of a diagram so that you understand. Okay. Number one. So in first paragraph, you say that. Next. Listen. What did the requirement tell you? They told you the impact on the financial statements and it should make a reference to the ratio. That part you still didn't come to that part. We only first see there was an error. What was the error? Error is they classified it into equity, but it should have been liability. Now you have corrected the error. So first paragraph, what did you do? Para 1, correct. You have corrected the error by saying it's a financial liability. This is what you are doing in the para 1, correcting the error. Once you correct the error, then only you can tell the impact. Para 2, paragraph 2, the impact on the financial statement. Impact on financial statement. Okay. So first, the impact on the financial statements of the error. Para 3, impact on the financial statements after correcting the error. So now you have an idea. Okay, what each paragraph, there are 3 paragraphs in this answer. What each 3 paragraph means after correcting the error. This should always be your guideline to do questions like this. If you have an error, first correct the error. Second, what is the impact with the error? Third, after correcting the error, what is the impact? Okay. First part is done. We have finished it. We said it's financial liability. What about second? It was equity, remember. So when it's equity, what happens? Second paragraph, I'm explaining this in detail now. Equity is overstated. Whenever they say impact on the financial statement means you have to use this two words. Overstated, understated. These are the two words. That's it. What is understated? What is overstated? Assets, income, liability, all those things. Assets, liabilities, income, expense, and equity. These are the five things. Remember, in your consumption framework, there are five elements in your financial statements. Those five elements. It could be anything, depending on the question. It could be an asset that is overstated or understated, liability understated or overstated, income or expense or equity. In this case, it's an equity, which is overstated because first you have recognized it as an equity. So equity will be overstated. Equity is overstated. Next. And what happens to the liabilities? And liabilities are understated. You have to write this. Otherwise, you're not going to get your full marks. This similar things comes for your audit also, triple A. Understated, overstated of assets and profit. Okay. That's why pay very clear attention to this because SBR, if you're planning to do triple A later on, mostly students do it after SBR as an optional paper because for triple A, SBR is very much linked. Okay. You need all your IFRS and IAS understanding to do your triple A. So please pay careful attention to this, how you write the answers. Now what happens? We told the impact. Impact part is over. What about the ratios? We didn't make any reference to the ratio. Can you see? Now you have to make that ratios also. Which ratio? Which ratio? See, whenever the word liability comes, okay, or equity comes, whenever equity liability comes, one ratio is very much important. That is gearing ratio. Not your profitability or liquidity or those one. It's gearing ratio. You have to mention this ratio. Because gearing is what? Simply your debt divided by your liabilities. So you have your debt with you. Gearing ratio. You have to mention this ratio. So gearing ratio will improve or it will become worse. It will increase or decrease. It will increase. It will improve the gearing ratio. Improve means gearing ratio will fall down. Gearing ratio will reduce. Why? Your equity is higher, asset liabilities are lower. Gearing ratio increases when your liability increases. Remember that. Higher the gearing ratio, higher the risk, which is not good. Lower the gearing ratio, better it is. If you are using more of equity compared to liabilities, it's good. Your gearing ratio will be low, which means your financial risk is less. But you are manipulating it, okay? Actually, your liabilities are more, but since you have classified a liability into equity, what you are doing? Gearing ratio will reduce, which may lead to underestimate Sterling's financial risk. You don't have to calculate a ratio. They didn't tell calculate ratio. They just told the impact on the ratios, okay? Because you don't have the figure. Come on, use common sense. You don't have any numbers. How can you calculate ratios? And if you don't mention ratio, you will lose that mark. 1 mark you will lose. You will not get the full marks for your answer. Which may lead to underestimate Sterling's financial risk. Please mention the name of the company. It's very important. You're not writing general answers here. You are linking it to the company given to you. Sterling's financial risk. Because gearing has to do with your financial risk. Underestimate. That means it will show the company in a good light, positive light, showing that they have less financial risk. But whereas actually they have more financial risk. You understanding? Coming to para 3. Para 3. What happens is the other way around. Now liability will be high. Okay. But remember, before going to liability, let's see equity. Now equity you will reduce the equity. So once you reduce the equity, what happens? Remember on equity, okay, when it was equity, you were charging dividends on it. Now the impact will fall here on the dividend part. So now dividend will go to dividends that has been charged on the equity instruments goes to retained earnings. Dividends that has been charged on equity instruments now go to retained earnings. Earlier, you were charging dividends on equity instrument. Now, equity becomes liability. So, no more dividend. It will go to retained earnings. Whatever dividend till now you have measured will go to retained earnings. And what happens? Now it's a liability. You will have a you will have an interest on that liability also, which is a uh, financing expense, right? Finance expense. Retained earnings. So, interest, where is interest? Okay. Interest on the financial liabilities goes where? It's charged to, it is charged as a finance cost and goes to P&L, right? It goes to the estimate of profit or loss as a finance cost. So what happens? What does this mean? Two more ratios. See, when you talked about profit and loss, talk about profit. Okay. See, you will get a clear link. Like this, you have to build your answer. So this means Sterling's profit. Whose profit? The name of the company. Sterling's profit. Because something will go to profit and loss means it will impact their profit. So Sterling's profit and earnings per share. You can also get earnings per share, EPS. Because earning is also based on profit only. So EPS will also be so here it will be understated once you correct the error. But before correcting the error, it would have been overstated. Remember this. Will also be overstated. But this was before correcting error. If you didn't correct the error. See this answer, you have two ways of presenting it. Either after correcting the error, what is the impact, or before correcting the error, what would be the impact? Like you never correct the error. I mean, you never show the impact after correcting error. Everything you want to show is before correcting the error. With the error, what is the impact? That also you can show by writing that their profit will be overstated before and EPS also. But after you put this, profit will be understated. Why? Because now you have a finance cost, so your profit will go down. EPS also will go down. Understanding? So that's it. So we are moving on to from accounting ratios to policies and estimates. What is the impact? We all know every standard till now that you studied, from starting from IAS 1 to IFRS 16, everything, it has estimates and it has some policies. Okay, what is the impact on this? That is very important. What is the impact of these policies? Okay, why? Because this accounting estimates and policies, they have a significant effect the way investors view the financial statement, because even the ratios are computed based on those policies and estimates. But remember, these policies and estimates doesn't have an impact on the entity's cash. It only affects the profit, only affects the statement of financial position and statement of profit and loss. That means your profit figure. So why this is important? Okay, this is particularly important issue when accounting standards permit a choice. Just having a policy will not have an impact, but if you have a choice, it has a huge impact. Why? The like choices like between cost of fair value model. Many standards has IAS 16 has IAS 38 has, right? IAS 40 has it. Why? Because when there's a choice, every company might choose the model which might be beneficial for them, even though that might not be the most relevant model for them. So you see, they can easily manipulate. In order to show them in a better position, they can use whichever model they find is suitable for them, because they are having a choice. Second, judgment. To make some estimates like depreciation, allowances, provisions, management need judgment. Even here, management could be biased. Okay, they might choose such depreciation rates or useful years they can change based on their wish, which favors their company's financial position. Again, it's a manipulation. Third, where there is no relevant accounting standard. This is very rare, okay, that you will not have any accounting standard. But if you don't have any relevant accounting standard, then also policies and estimates could have an impact because you don't know how to deal with it. If a certain standard was there, you know how to deal. For example, revenue recognition. I know how according to IFRS 15. But if no standard is there, how do I know how I deal with it? So some estimates I'll give to it, then it becomes very difficult. For this reason, impact of these policies and estimates becomes more important. Otherwise, someone can just estimate any way they want, can have any policies they want, but because it has an impact, you need to understand this. Okay, now let's do a question on this. So in this question, test understanding 3, you might be thinking why you need to test understanding 2, because test understanding 2 comes under your earnings per share, EPS. This I've already done when I did my IAS 33. You need to go back and check my IAS 33 earnings per share. There I've done test understanding 2. But the same standard IAS 33 comes under this chapter only in your textbook. Okay, that is analysis and interpretation. Okay, so test understanding 3, impact of policy choices. Okay, 2 entities are there. You can see statement of profit and loss is given. Profit is also given. Statement of financial position is given for both A and B, but they have different models. They are identical in all respect except how they apply IAS 16. Entity A goes for cost model, entity B goes for evaluation model. Okay, so now let's see. The requirement is asking, using ratio analysis, compare the financial statements of A and B and explain how the differences may impact the stakeholder perception. This is a more open-ended question. This is not something that you have come across till now because you have been applying something to a standard. Okay, you need to calculate ratios first. Ratio analysis means ratios needs to be calculated first, then only you can analyze. Without calculating, you cannot. So let's do that. Okay, what are the ratios you can calculate? Tell me. One ratio is gearing ratio for sure because you are given the borrowings, equity is given. So one ratio is, gearing ratio. You have to decide which, see there are so many ratios that you've gone through. You have to be very smart enough to choose which type of ratios. Okay, even though you are writing only 2-3 ratios can show you the maximum impact. You can get the maximum answer from it. One is gearing ratio. Gearing ratio has 2 formula, debt divided by equity or debt divided by debt plus equity. You have to clearly specify which one of the two you are using. So here they have used debt plus equity, this ratio. So you have to mention it. If there was only one formula, even if you don't mention, it's fine. But whenever there are 2-3 formulas for single ratio, you have to tell which one. Okay. So for entity A and entity B. Next ratio. First we'll decide the ratio. One ratio is gearing ratio. What is the other one? Profit is given. Okay. So why not operating profit margin? You have to use both the statement, by the way. It should not be that you are only using ratios from statement of financial position or only from statement of profit or loss or only profitability ratios or only gearing ratios. No. Ratios should be from wide areas, not just one type of ratio. Okay. One is gearing, the other one will be profitability ratio. That could be operating profit margin. Operating profit margin has the same formula, operating profit divided by revenue. So I'm not writing the formula down. Next could be your return on capital employed, ROCE. Okay, this is a very famous ratio, by the way, ROCE, that is often used by investors. Okay, see so many ratios that you have went through: stock turnover, debtor, creditor, receivable. But can you do this information given to you? Can you find those ratios? You can't find. You don't have the stocks, you don't have the receivable, you don't have the payable, then you don't have your asset test ratios, working capital rate. You cannot do all those things. Information is not given to you. Information is only given about gearing, operating profit, and the other one is returning capital employed. 3 things you can find. Okay, and this comes with practice. How will you decide? It comes with practice. The more questions you do on ratios, the more you will know to pick the right ratios. Okay, picking the correct ratio is also important. Okay, here you have to be wise enough. So let's do the gearing for A. Debt. What is the debt? You have to take long term. Okay, that is your borrowing 100. Total equity plus liability, it comes here 240. So 100 divided by 240. How much? So it's 100 divided by, for A, 100 divided by 240. How much? 41.7%. It is 41.6666 something, but round it up to one decimal place. Doing the similar thing for B. B would be 100 over 420. It's more. Remember, the denominator increase means your ratio percentage will fall down. It will be less than 41.7. It will become at least half of it. So 23.8. You see? That means you are having more of equity in the base. Coming to operating profit. Operating profit is simply profit 40 divided by 220. Here it's 10 divided by 220. So obviously in A, okay, you'll be having a bigger percentage because you have 40, and here you are having less profit even though revenue is same. So here it will be 18.2%. Here it would be 4.5%. Such a difference, drastic difference, just by having a lower. Here you had 40 as a profit, here you had 10, and I think revenue was 220. Revenue was same, only profit differed. Yeah. Return on capital employed. This is your operating profit divided by capital employed. So your operating profit is already it's given 40 and 10. So 40 is your operating profit, and capital employed, it could be 240. So let's do, which is 16.7%. And 16.7% for A. Do the similar way for B, okay, and find the answer. But I have got 2.4%. Okay, this is up to you. It's your homework. Try to get the 2.4%. Okay, if you see, it's very easy for you to compare. Why? Because if you go by gearing, if you go by operating profit, if you go by ROCE, in every aspect B is less. B's ratio is very less, which is not good. So it's very easy for you to decide which company is performing better. You can see that just having a different policy, that is cost versus revaluation model, such a drastic impact on the ratios. Why is it so? Why do you think? You have to explain the points. Why do you think B has less? Because of revaluation. Now comes your explanation part. B, okay, B will be charging more revenue, sorry, more depreciation. B charging more depreciation on the higher value of your asset. Correct? They will charge more depreciation. So because of more depreciation, what happens? More expense in P&L. More expense in P&L means lower profit, which is correct also. You see, they are having a profit of 10, whereas A is having a profit of 40. Then A. Okay, then A, you have to write then A, because you have to compare the two companies. Whenever you are comparing, you have to write then this person, then that person. Okay, entity B are lower profits, and therefore lower operating profit margin, because lower profit. Coming to next, revaluation. Okay, because of revaluation, increased equity. This is B's, okay, I'm talking about only B. So B has increased equity. So because of increase, it reduces its return on capital employed, because your denominator increases. It is, see, ROC is operating profit divided by capital. This capital includes equity also. So higher the equity, your denominator goes down. Sorry, denominator value goes up and your answer goes down. Try it and see with any number. So it makes the company B less efficient than company A. Now we'll talk about the gearing. What about the gearing? Even B's gearing is less than A. So in this case, B is less risky than A because low gearing. Here also is the same thing because this increased. Denominator goes up, value goes down. Sorry, denominator goes up, value goes down. Usefulness of the statement of cash flow. Now, not everything you can pick from statement of profit and loss and OCI or statement of financial position. That's why stakeholders need this. There are reasons for it. Number one reason, unlike profit, cash cannot be manipulated. Why? Because profits, to calculate profit, you are using so many accounting policies, right? There you are having a judgment and you have to make a choice. But in cash flows are objective and you can verify them. Second reason, cash that is generated from operation. You see, there are three types of cash. If you went through IS7 cash flow, you know that there are three types of cash. Cash flow from operating activity, cash flow from investing activity, cash flow from financing activity. Out of these three, the first part, operating activity, that is the most important. Why? Because it talks about the quality of the profit generated by business. A good quality profit only will generate cash. You can have a high profit, but you might have low cash. It's not good. It's not worth it. But with that profit, you're having a good amount of cash. If your cash inflows, if it's a cash flow positive, that means higher cash inflows than outflows, it's good. This information you will only get through statement of cash flow. Third, statement of cash flows gives valuable information to stakeholders. It talks about financial adaptability, how financially solvent an entity is. And the last, it gives some predictive value. Like looking at cash flow statement, someone can predict the future. And stakeholders might know what is the amount that they need or they need to borrow. What is the timing, right? And the certainty, all these things you will know through looking at the statement of cash flow. These are the uses of it. Let's do a question on usefulness of statement of cash flow. Test your understanding 4. You have been given the statement of cash flow. Okay. You have to analyze this now. Okay. See, most of this cash flow statements and all we have covered in with standard IS7. Okay. In case you forgot, now you need to go back to my IS7 lecture and recall it. Okay. Refresh it and come back. But if you remember, let's go ahead with the analysis. You should be able to know how to analyze as well as calculation. Calculation part, I've done it in IS7. I'm not repeating it. See, already the amount is given to you. Now you have to analyze this company. Okay. So what is given from this case study, the only important thing is it says that as at the year end, this company has loans with repayment of 7 million due annually in each of the next 4 years. Okay. So here you see you have cash generated from operation. Then you have cash flow from investing activity, which is outflow. Here you have from operating activities just 3, which is very low. And from financing activity, which is 8. And finally, closing cash balance is this. So your cash flow increased only by this. Okay, at the year end, you are having a negative, but it's not a good sign. So now, from the analysis of the statement of cash flow, which conclusions would you draw? See, when you're analyzing statement of cash flow, okay, divide this into 3 parts. 3 separate parts you have to analyze. Operating activity, investing activity, financing activity, and finally the conclusion. OIFC, operating, investing, financing, conclusion. This is how you do it. Okay. And here you have been given. So from operating activity, just see. Only this part you need for operating section. What are you seeing here? Starting with profit. You have finance, depreciation. Okay, those things are fine. We are working more on this parts. We are having a reduction in provision. Increase in inventory. You see, increase in inventory. Which are the alarming signs? Increase in inventory is not good. It leads to more cash outflow. Increase in receivable. Your customers are not paying. They are paying late. This is also not good. 1, 2. Increase in payable is good, but it has a bad side also. Your supplier might withdraw the credit facility later on. Provision is reducing, which is good. This is a good sign. Okay, then we have tax paid and interest paid. So you can talk about each one of this individually. Okay, you see the answer. I have copy pasted the answer for you. Okay, this is high level analysis. High level analysis means together everything they have summarized it and showed it in the beginning. Oh, okay. Or maybe they have just talked about the looking at the closing cash balance. So let's see what they have included there. Okay, he has generated a cash surplus during the year. Okay, but it's very small compared to the size of its outgoings. Why it was 1? Why did it was a cash surplus? See, because it was 1. It's a surplus, no? It's a positive one. That's why. But it's very small compared to, right? Relatively small compared to the size of its outgoings. Outgoing is more. So here they have a negative overall cash position. That means it has an overdraft. Looking at it, you can tell this one thing. Okay, because of this overdraft, it will lead to increased interest payment. Okay, this is a risk. Why? Because overdrawn could be withdrawn anytime. So there's a considerable risk. This is high level analysis. Now we'll go in detail to each one of it. Starting with operating cash flow. You see, operating cash flow. They have a subheading. Then they explained. Then they have investing. Then they explained. Then they have financing. Then they explained. Okay, so conclusion is basically they have explained in the beginning only. That is high level analysis. You can do it like this, or at the end also you can do it. It's not harm, no harm. Okay. Starting with operating. Okay. So here what they have done, each thing will be explained in each paragraph. For example, in the first one, it is about operating profit. Next one, it is about the inventories. Then it's about receivable in the next third paragraph. Then whatever is the bad sign, I mean, not good, explain it. And then comes mandatory interest and tax payment. This you cannot, it's mandatory. So these are the 4 things. So what about operating profit? What was operating profit? We need to go back. 35 plus 5. This is the operating profit. Profit before interest and tax. You have to add that finance cost. Then only you will get profit before interest and tax. That is your operating profit. In other words, 35 plus 5. That's why they've explained here. 35 plus 5, 40. So operating profit is 40. Okay, but if you see, it has already generated 18 million. Cash from operations, generated cash from operation. This is an important thing. It's only 18. You see how? Go back. It's only 18. This one. I've circled it before. Cash generated from operations. You have to talk about this. It's main thing. It's only 18. Even though operating profit is 40, but cash generated from that operation is only 18. Very less compared to profit, right? What does it mean? This suggests that their profit is low quality and are not backed up by cash. Coming to inventory. You see, inventory is increasing. That means it will have a negative impact on cash flow. Why could it be? Try to give reasons. Try to imagine why inventories could increase. Maybe it could be a response to bulk orders. Okay, maybe someone has a bulk order. That's why you are inventorying, putting everything under inventory, right? Although it could be due to inefficient inventory management also. Could be exposing them to risk of inventory obsolescence. Having too much of inventory is also not good. Coming to the receivable side, this is not good. That means customers are paying more slowly. Okay, it would seem that the company is compensating this by taking longer to pay its own supplier also. You see, even your creditors are increasing because your customers are paying you late. You are also paying late to your supplier. This is not good because it might supplier might tighten or remove the credit terms later on. Coming to interest and tax, these are mandatory. Okay, but there is a small cash surplus of 3 million only from operating activity. Okay, so overall, you can conclude that their trading operations are not generating enough cash to invest in PPE or to repay the loan. So because of this, because you're not having enough profit, enough cash from operating, what are you doing? You are obtaining this fund from other less sustainable sources by having more loans. Now coming to investing. For investing, we have to go through the diagram. We only have one purchase of PPE, that is 30. And this is also an outflow. So investing, obviously, most of the things are explained in under operating. Investing and financing are usually less to talk about. So here we are only talking about PPE. Okay, they've invested this. Okay, next, if you see substantial receipts are generated by selling this PPE. Okay, and this is, you need to understand that this is not a recurring. It's not a recurring cash flow. Every year you will not get this. It's only one time. So without this receipt, okay, without this receipt, what happens? They will have an overall decrease in cash and cash equivalent. It will decrease. It would not have increased by one. Next, because you have disposed, the high level of PPE disposal raises concern. It's not good if you sell off so many of your assets. It raises concern. Does they have ideal assets which may require impairment, or is it being forced into disposing of key assets in order to raise cash? Because you need this assets later on. If you're selling this to raise cash, it's not a good thing. Coming to financing activities. Financing, we have proceeds from share, repayment of loan 7 has been done. Okay. Here. So they repaid some of its loan. Okay. Even interest will reduce in the future because of this. So your operating cash flow will free up. Correct? But loan repayment was only possible as a result of share issue. If share issue was not there, loan repayment would become very difficult. That means they cannot perform share issues indefinitely. Therefore, high operating cash flows are required. You need a high operating cash flows if it needs to meet its future loan repayment. Can you keep on issuing shares every time? Can you raise your finance that time all the time? No, only once maybe or twice. Thereafter onwards, you have to raise your operating cash flow to make future loan repayment, to repay your loan. He has not even paid a dividend this year if you see. So no doubt due to his poor cash position, obviously, if your cash position is not good, how can you pay dividend? From cash only you pay dividend, no? So this may deter the potential and current investors from providing further resources. This is how you analyze. You can analyze this in any way you want. But certain things has to be there. Okay. Now we are moving on to additional performance measure. The short forms is known as APM. This is tested. This was tested in SBR. I think quite very often this area is tested. Okay. So now there are 4 types of APM. Okay. Sometimes they might give you a new APM also, but they will give you the formula in the exam. Okay. But these are the common ones. EBIT. EBIT means earnings before interest and tax. Then we have EBITDA. Earnings before interest, tax, depreciation and amortization. Then we have net financial debt. That is gross debt minus cash and cash equivalent and any other financial assets. Free cash flow. Cash flow from operating activities less capital expenditure. Okay. Free cash flow means this cash flow is free. You can do anything with it after you have taken off your capital expenditure and any obligatory cash flows are taken out. Now, benefits. What are the benefits of this? In your exam, they might ask you for the benefits of the benefits to the company. Number 1 is it helps users to understand the entity through the eyes of the management. Second, comparison can be done between entities in the same sector. Third, striping out elements that are not relevant to the current or the future year operating performance. See, additional performance measure, you can change this figure. You can often change it based on what you think is relevant this year or next year. But if something is fixed, you cannot change it. Every year you have to use that same measure. That is one benefit. But we also have drawbacks with it, and quite often we have drawbacks more than the benefit. What is it? Number 1. Each year entity might calculate APM in different ways. So it's difficult to compare year on year because there's nothing fixed. APM, anyone can define it. Entity can define it any way they want because it's something additional. Okay. Second, two entities can calculate the same APM in a different way. Why? Because there is no uniform guideline. There is no particular standard IFRS standard that says this is how you have to measure APM. That's why. Third, even though APM is calculated, even the information is disclosed, but information is very little. Okay, users does not understand how the figures are reconciled with the financial statement. Then APMs are often selected and calculated by the entity to show them in a good light. Okay, they show overly optimistic picture of their performance, which might not be true. Then too much information can confuse the user. They don't know which is important and which is additional information. Giving an undue importance to this APM, okay, makes users think that this is also a requirement of IFRS standard. But whereas, let me tell you, this is not a requirement of IFRS standard. This is something voluntarily that if you want to do, you can give. IFRS standard does not say you this. So now let's do a question on APM. Test your understanding 5. Okay, here the additional performance measure is known as underlying profit. Do we know what is underlying profit definition? According to any standard? No, but they have calculated it. Okay, this is how they have got the underlying profit. They have shown you, starting with loss before tax. And they have given comparable information for the prior period also. Discuss why this APM may not be useful. They have already given you. The question is not whether this is useful or not useful. Why it is not useful to the stakeholder. I copy pasted the answer for you. But before that, let's see what are the things included. Loss before tax, finance cost, depreciation, amortization, impairment of brand, foreign exchange loss on monetary items, and gain on this stands for fair value through profit and loss financial assets. Okay. So see, when you're talking, how do you answer this? You have to talk about one by one, starting with depreciation, amortization, impairment of brand, foreign exchange gain on this thing. Each one you're talking in different paragraphs. Maybe this two you can include together because they're similar. While one is for tangible, the other one is for intangible, but the meaning is same. So that's what here they've given you the answer, right? Here it looks like big, but try to break down this. Okay, I will tell you how. First two is about depreciation and amortization. Then it is about the impairment of brand. Then it is about the foreign exchange difference. You see, your first word in the paragraph should exactly tell what you're talking about. This saves a lot of time. This is what you have to apply, adopt in every answer, in any ACCA paper. Okay, when you're starting the paragraph, that starting line of that paragraph matters the most. Everything you're explaining and then you are saying it's foreign exchange difference, then it's about impairment of brand. It's not, I mean, see, we didn't even read the paragraph, but we still know what the paragraph talks about. You should write it in a way. How? Just looking at this first one, impairment of a brand. Then the next one is about fair value gain on financial assets. So you see each item is explained in different paragraphs with spaces in between, around 4 to 5 lines. Here they have written more, but generally you have to write 4 to 5 lines, more than you are not expected also. And then overall. Okay. So first we'll go one by one. See, depreciation and amortization are judgmental. We use judgments for it. Okay. They are non-cash expenses, number 2. First is judgmental, number 2 is non-cash expenses. So excluding them from underlying profit ignores the fact that the entity's non-current assets will need to be replaced or enhanced in the future. So if you ignore them, that means they are not important. Okay. You are ignoring the fact that entity's non-current assets needs to be replaced or enhanced in the future. Second, impairment of brand. See, because you need to include this in your underlying profit. Why? Because depreciation and amortization will happen. Even though it's judgmental and non-cash, it will happen. Your assets will wear and tear out. You need to replace it. It needs to be enhanced. Coming to impairment of a brand. Okay. So impairment of a brand. Yeah, the word impairment of a brand. The word impairment says that means your brand value went down. Okay. So weaker than expected. The outlook is weaker than expected. This is what it suggests. So it also indicates that management overpaid for the brand. Could be. Maybe managers are overpaid for this brand. So adding back this expense when you're calculating profit, diminishes its significance when assessing the past decision of the management. You see, you're adding back this expense when you're calculating profit. But when you're adding it back, you're showing a higher profit. That means you you will not be able to assess the past decision of the management. And also when predicting their future performance, you will not be able to do it based on this underlying profit because you've added it back. Foreign exchange differences. What happened? What happened with foreign exchange differences? You see, you are adding it back. Impairment of brand, you have added back. It's an expense. All this and non-cash, you have added it back. This is also foreign exchange loss you have added. Obviously, gains, loss you will add and gains you will deduct. Anyway, so this one, you have added it, but it's very volatile. And it's very difficult to compare an entity's performance year on year also for this one. And it is not something very frequent. It's a one-off item. However, these financial assets are likely to be sold in the short term, and so the gain and losses will be realized shortly. They are also unlikely to be the one-off items. Entities that trade material quantities of financial assets will probably enter into a similar transaction on a regular basis. Okay. So if you see what is the overall performance, it's a loss. If you see the underlying, okay, they are showing 19, but adding all this is not correct. That's what they are showing. So overall, it looks like they are trying to disguise a weak performance. They are trying to hide it. Particularly as this one has turned a loss before tax into a profit. You see, how is it happening? How is it possible that before this they are loss and suddenly APM becomes positive? That was 8 to 19. Such a big difference. Not even a small amount. You need to be a little suspicious of all this, right? You have to be skeptical about all those figures and all. So this could be misleading. It could be misleading. High chances are there. Especially if you are having so much you are stressing importance on this APM. That means something is wrong. Because this is not a requirement of IFRS. If it was, okay, pay attention, no problem. So however, to their credit, it discloses the calculation behind the APM. It's good. In a way, it's good. They have disclosed how they've calculated, thus allowing users to reconcile this figure in the financial statement. So this will enable them to draw their own conclusions about the adequacy and the usefulness of this APM. Every user will have their own conclusion, whether this is useful or not. Okay. Now we are moving on to the tech companies. Why tech companies specifically? Because these companies have some limitations. Okay. And its valuation. That's why. Number one reason. Like companies like Amazon, Google, Facebook, and Apple has a huge concern. What is their growing concern? That financial statements, okay, that are produced under IFRS standard do not produce useful information, especially for tech companies like Amazon, Google. Why? We'll see. Statement of financial position. So in the statement of financial position, these tech companies, they often underreport their significant amount of value. See, all these tech companies have their value. Huge values are derived from their intangible assets. 85% of the value comes from their intangible assets, from their brand, from the intangible asset that they have internally generated. Okay. And we know that according to IS 38, internally generated brands are not recognized in the statement of financial position. So because they are not recognized, the value that is given in statement of financial position is very low. You can say underreport. So it's not their true value, which is there in the statement of financial position. Financial statements are showing even a lower value, but their actual value will be higher. Okay, this only applies for tech companies. Okay, companies with valuable brands like Google, Amazon, Facebook, Apple, like that. Normal company can apply because their success lies in their tangible assets. Okay, another reason is that their operating assets that tech companies use, they are not owned or leased by the company itself. Like music that is available on Spotify or the cars that are available through Uber app, these are not owned by the company itself. These are third parties who are owning them or leasing them. Okay. Just like that, but you are getting the value because you are bringing customers to them. So customers are contacting you, so you contact the Uber. who is not owned by you or not even leased by you. They're the third party. They are doing everything. You get the customer to them. Okay. So when you are recognizing it, so according to the conceptual framework, you cannot even recognize an asset. How? Because to recognize an asset, you have to own it. But here you are not owning it. This is specifically for tech companies. Okay. That's another concern. Then another reason is, okay, according to the standard, if you go by IS 38, intangible assets you have to depreciate or amortize. Sorry, if it's a tangible, depreciate, intangible, amortize, right? But what happens is tech companies, their intangible assets, they appreciate in value. Okay, they appreciate in value, but accounting standards say you depreciate or you amortize. So it's not going in line, you know. Now coming to statement of profit and loss, how this has an impact. Okay, the impact is in the initial years, tech companies will incur a very high cost. But once these costs are incurred, the further costs that are required to expand will be very low compared to the costs that have been incurred in the beginning. It could be a long time, maybe 7 years, first 10 years, first 5 years. Okay. So when you are valuing the company based on statement of profit and loss, a company you might be thinking it's a loss-making company because first 3 years they are giving loss. But actually the profit might come in the fourth year or the fifth year or the seventh year because it's a tech company. Every tech company has this feature. It's not So you cannot say it's going to be a failing company or something. You cannot predict based on statement of profit and loss. Specifically for tech companies. If it was some other company, okay, makes sense. That is a loss-making company, so we should sell the company. But for tech companies, you need to have a lot of patience before loss-making turns into profit-making. Okay, because this pattern is followed by all tech companies. What are the remedies for it? The remedies is you need to report other types of information for tech companies to the investors and lenders. Like it could be done through integrated reporting. Integrated reporting we are going to learn in this lecture. That will be the next topic. Then you can supply them with online real-time key performance indicators like membership number or monetary spend per user. Okay. Now, coming to non-financial performance measure. We have already analyzed a company using financial performance, but relying on them has problem. If you're just relying on financial performance, it's a problem. How? Number one, financial performance are calculated from historic values. For future, it might not give a very useful information. Next, financial performance do not give you useful information that can impact your long-term success. Like long-term success comes through your customer satisfaction. But through numbers, can you understand how satisfied your customers are? No. Third, like we said, limitations for tech companies if you go by traditional financial reporting. Okay. Then because accounting statements can easily be manipulated through policies and estimates. So that's why we need non-financial performance also along with financial performance. Don't look anything in isolation. Treat both of them together, combine and then see the whole picture. Finance with non-finance. That's how you analyze a company. So these are the examples, some examples of non-financial performance that you can use even in your exam. Number one, employee turnover. Higher the employee turnover, bad it is for you. That means more of the employees are leaving your company. You have to retain them, especially the skilled labor. Next, absentee rates. If this goes up, it's not good. That means your employees are not satisfied. You have to keep them satisfied or motivate them. Employee satisfaction, yes. Customer satisfaction. Delivery times. Are you being late? Are you delivering on time? Then brand awareness and brand loyalty. All these are non-financial performance. Okay, let's do a question. Test your understanding 6. Lorenzo. Okay, so here Lorenzo develops and manufactures desktop and laptop computer. Okay, profit after tax is 5% lower than the prior period. They disclose their non-financial performance measure also. Now, these are the non-financial performance measure. Falls per thousand sales. If you see, it reduced, right? From 2000 to 2001. You have to go from right side to left. Then customer service. If you see, it also reduced, which is good. Customer service helpline waiting time in minutes also reduced. Staff turnover became almost half in terms of percentage. Okay, so this is a star. That means this is how they have calculated the staff turnover. Levers divided by average number of employees. Now you need to discuss how the information will be interpreted by the investors. When you're writing this type of answer, you need to divide this into paragraphs with subheadings. How? Let's see. This is the answer. If you see the answer, they have divided the answer like this. They have given one for profit, then the fault, then the helpline. So each item they have reduced. Here is the profit, one paragraph, then the fault, then the customer service, then the staff turnover. Okay, so staff turnover and then summary. So we'll go one by one. Okay, you don't have to exactly copy paste this answer. What you can see, they already told profit declined by 5%. Okay, so because profit declined, it's a concern to the investors, isn't it? But we'll see this with the non-financial information. If you just go by the profit, it is not so good. It gives you a negative signal. But we'll combine this with the non-financial performance also to give a more full picture, holistic picture. Okay, because if you go by the integrated report, it gives more optimistic picture because fault reduced, helpline reduced, employee turnover reduced. Now let's see the fault. Fall also declined. So decline fall means what happens? You have to show which places can have this impact, positive or negative. A decline in number of fall means products will reduce their future repair costs. Repair cost in the future will reduce. This will increase the profit. Everything you have to link with the profit. Okay. Fear fall will improve customer satisfaction also. Okay. This will generate strong brand loyalty. Customers will become repeat purchasers. You see, this is something which you can say other than customer satisfaction, you can say something else also. This can improve the brand image. This can give a good reputation to the company. Anything. Okay. You're free. As long as you give something which is okay. I mean, which fits well with it. Coming to helpline. Okay. Helpline also reduced. What does it mean? This may be due to the reduction in the number of the product fault. You see, you should be able to link in between them. This you are linking with the fault. Fault reduce means helpline also will reduce, obviously. Why do you need help? If there are more faults. But if fault reduce, helpline also will reduce now. Okay, that means they have done a customer service department. They have made an investment here. So whatever the reason, this is likely to have a positive impact on what customer perception. Everything try to link with the customer because ultimately through customer only you will get the profit. Okay, even in your exam, anything try to link it with customer satisfaction. So this will likely to have a positive impact and will lead on a customer perception. Once again, improve brand loyalty. Try to fix with one thing. If you're saying one thing in the first, try to repeat it and in the other points also. Like if you see here, first point says about brand loyalty, second also says about brand loyalty, third also make sure that it sticks to that. Okay, it makes your answer more stronger. Coming to staff turnover. Okay, even this reduced. Okay, why it could reduce? I mean, what could be the impact of it? So staff turnover reduce means that means staff experience is being retained in the business. They are being more. They are retained. So because they will be more skilled and they are retained, okay, this will reduce the recruitment process and training costs also. And also experienced staff will perform at higher level compared to inexperienced staff. Okay, so this also partly explain improvement in fall levels and customer helpline waiting lines. You see how you're linking staff turnover with this and with this. You should be able to do this. This is a skill that not many of you have it. You need to practice it. It comes with practice. This is why I'm taking you through this answer to show you how they have linked it. So because fall reduced, helpline reduced, maybe staff turnover could be a reason of it, right? Partly it can explain reason. So reduce staff turnover. That means if you're having the experienced staff there, it will help you to have helpline will reduce and also fault also will reduce because they are more experienced in performing at higher level than the inexperienced staff. Okay, so reduce staff turnover will have other benefits like what? They can develop more innovative products in the future. This is something you can talk, anything you can talk. Okay. Now summarize everything. So if you just go by profit, it's a pessimistic view. But if you link this with the profit, it shows a pessimistic view. So now, in conclusion, what would you say? How would you conclude it? The non-financial gives into their future prospect, talks about future rather than the past history. So you can compare this performance with other entities in the same sector. But some may even question the reliability of this also. Why? Because unlike financial information is audited by auditor. We know whether it complies with a relevant standard or not. But what about integrated reporting? This is not audited. So reliability is questioned. But if assurance is given by some assurance practitioner like auditing, maybe if this also you could audit, or some assurance letter is given, then maybe investors would like to rely on it. Okay. Test understanding 7. This is environmental impact. Okay. Discuss the benefits that may arise when entity discloses its impact on the environment to stakeholders. Okay. So here, what are they doing? They're investing more time and money in implementing sustainable development practice. Their goal is to minimize the impact of business on environment. And now they're disclosing information also. So now let's see. See, this answer is a very good answer. You can learn this for any. It's like these are the benefits of reporting about environment to the stakeholder. You can memorize some of the points. It will help you in the future. Okay. The answer you can take it from here. So let's go one by one. Okay. These are the advantages. Some advantages are there of disclosing its impact on the environment of any entity. One advantage is what? See, if you go by traditional financial reporting, it only gives very limited reference to environmental issues. Does it talk? No. But if you fill this information gap by giving information about environment, then it can meet the need of certain stakeholders. One advantage is this for the stakeholders, because this is advantageous for the stakeholders. Okay. Second, if you are giving more information to stakeholder, it increases an entity's accountability as it is more difficult to conceal the information. Entity's accountability is increased. Third, you are reports that demonstrate an entity is managing environmental will improve the perception of its sustainability. They are regarded as more concerned about the environment, more sustainable. Okay, this will help them to go till long term, sustain their business till long term. Okay, that means they are shown as a good citizen. And good quality reporting may make an entity more attractive to the investors also, especially if they see that risks to sustainability are being managed. That means you are taking care of environment. If investors see this, they will see it in a more attractive. Okay. Now, so this is non-financial reporting, isn't it? Regarding about environment and all, it's non-financial. So this, okay, non-financial reporting is increasingly regarded as a best practice. Nowadays, if you go, it is regarded as a best practice. So entity's corporate image will improve. Then, okay, see, this is based on number of marks. Okay, this is all the possible advantages they have given in one slide. Green consumers. They are more likely to buy from entities that are open and transparent. If you give more information about the environment, green customers are more likely to buy from you. Then, if you are concerned about the ethical stance regarding your supply chain, okay, then disclosing quality environmental information may make an entity more attractive supplier also. That means you are more concerned about your supplies, makes you more attractive. Then environmental reporting increases community support also. The community gets along to support the entity. And the process of evaluating this performance, environmental performance, may highlight inefficiencies also in operating activity. So managers could improve the entity system through this. It can help you in your financial aspect also. Your profit might increase. For example, you might be seeing that a profit is declining. You never knew why. Maybe there was some issue with the environment that is causing that decline. So solving that by having an environmental performance, okay, evaluating it, you come to know, you will come through other various sustainable resources that you can replace, through which your profit might increase, or you might switch to some other country where uh, what do I say, entity takes more care of the environment, something like that, right? You will get solutions. Okay, so it shows advantages of environmental reporting outweighs the disadvantages. That means it's more better than not to give an environmental reporting. Integrated reporting. This is the last section for this lecture, and with this we'll conclude the lecture. Integrated reporting, you have studied this in your other subjects as well, like integrated reporting is there in your SBL and maybe from your F level papers also you have studied. So you know the concept briefly about integrated reporting, right? Integrated reporting is often asked in many papers, not just SBR. It could be in tax, it could be in AAA, it could be in your AFM, right? So that's good because it makes my work easy. Okay, so in integrated reporting what you need to know is what are the things you need to include basically. Okay, and trust me, it is one of the easiest thing. Okay, but writing including things in integrated reporting is difficult even though you know what to write. When it actually comes to writing, it becomes very difficult. I will show you this, I will demonstrate it through a question. Okay, but first let me finish the concept of integrated reporting. Integrated reporting is unlike your financial statement where it only has finance. So integrated means it's a whole approach. Okay, it looks into the company from the holistic view. It includes both financial and non-financial factor in that report. Okay, but how do we prepare that report? For that preparation there are some principles that you can follow. Okay, they are known as guiding principles. You don't have to memorize this principle. Okay, just know what are the principles, on what principles you have to prepare the integrated reporting. Okay, so basically integrated reporting is prepared to know or view the company from holistic, I mean whole picture you can grasp, not just finance but non-financial factors also, not just the quantitative but the qualitative factors also, like your sales, your customer, your environmental factor, those things, right? It's very simple. Okay, so first, when you're preparing an integrated reporting, it should have a strategic focus and future orientation. Okay, whatever your company strategy, okay, what your it should give an insight to the company strategy. What is the company strategy to reach its future goal? Okay, in short, how are they creating value in the short, medium or long term through its capital? There are 6 capitals in integrated reporting that you need to know: financial capital, human capital, intellectual capital, social capital, manufactured capital, right? The list is there. Okay, so through using those capitals, how are you creating value? Okay, second, your information should be connected. One piece of information should not give an information from the other which is very contradicting with the other factor. They are interlinked. Okay, for example, if your customers are not satisfied, if you are seeing that through customer satisfaction report, through a survey that customers are not satisfied, it is very unlikely that your profit will be high, right? So it should link. Third, stakeholder relationship. Integrated reporting should say what is the quality of the relationship with the stakeholder and the organization. Okay, then fourth principle is materiality. You should only include those things in integrated reporting which can materially affect the organization's value, not every little things. Then conciseness. You have to keep information very brief so that when users read it, they do not become overwhelmed, okay, by too much of information, okay, that they lose the sight. So keep it brief and to the point. Reliability and completeness. The report should be complete and it should be reliable. Okay, that means it should be balanced and free from any error. Consistency and comparability. It should be consistent and you should be able to compare it over time and with other entities. It should be prepared in such a way. Now, we are coming to the content of an integrated reporting. Those were the principles. Okay, what are the content? What an integrated reporting should contain? Now, when a statement of financial position, we all know it includes assets, liabilities, and equity. When it's profit and loss, we know it includes profit and loss. When it's a statement of cash flow, we know it includes cash flow from operating, investing, and financing activity. What about integrated reporting? It also has some content. Okay, so the first content is the organizational overview and its external environment. That means what does the organization do and what are the circumstances under which it operates? What are they currently doing? Second, how are they governed? How are they structured? What is the organization structure? Third, what are the opportunities in the future and what are the risks? And how are they going to manage those risks? What are their strategy and how are they allocating their resource towards it? That means where the organization is today and where it wants to go and how they intend to go there. What measures are they taking? Business model, very important. What is the every company has a business model. What is your business model? Has to be there in the integrated report. Performance, yes. How much has the organization achieved its objective? Future outlook. What are the challenges and uncertainties if you pursue with your strategy that you are going to face in the future? Okay. Basis of presentation. How does the organization determine what matters to include in the integrated reporting and how much matters quantified or evaluated? You have to see this. The things that you're presenting, how did you decide that this will be presented? Based on what? Based on materiality, whether you can quantify or whether you can evaluate them. Okay. So that's it. And let's summarize. Before we do a question, I usually put the summary at the end, but let's summarize today and then we'll do a question for this one. Okay, so first is financial ratios. Okay, we started with financial ratios. Financial ratios were divided into categories. We have profitability ratios like operating profit margin, return on capital employed, and gross profit margin. Then we had liquidity ratio, working capital and assets ratio. Then we had gearing ratio. Then we had investor ratio. We had so many ratios, right? Make sure that you know the formula. Second, what are the impact of policies and estimates? Third, usefulness of the statement of cash flow. How you can interpret, okay, once calculations are done. Fourth, additional performance measure. What are the advantages and disadvantages? You should know. 5, tech companies. Why tech companies have limitations when you're valuing them through financial statements and profit and loss, and what could be done as a remedy? Non-financial performance measures. You have to take this also when you're analyzing a company, not just finance. And integrated reporting includes both those financial and non-financial matter. So now let's do a question. Test understanding 8. Okay, so this is about a company AA. Okay, now you can take your own time and read the entire case study. Okay, your required is why would an integrated reporting provide useful information about AA? Sorry, that means they have included everything about their capital, 6 capital that we have been talking about. Okay, now just have a glimpse of the answer, how the answer looks like. The answer is really long. You don't have to write that much. Why? Because with the time given to you in your exam, you are not in a position to come up with this full-fledged answer, okay, and this lengthy answer. But make sure at least some parts of it you cover well, so that you get the maximum that you can score. It's impossible for you to be perfect in an answer. So please do not try to be perfect. Rather, you have so many other areas where you can score high marks, like through your IFRS and IA standard. Okay, maybe here you are not able to write so much, it's so fine. Okay, remember pass mark is 50. Okay, so here they have given, okay, how they started. Just look, I just want to show you through how they have answered. Always start with the positive issues first. There will be both positive and negative issues in an integrated reporting. First highlight positive issue, then highlight negative issues. Okay, so in 3 positive issues. Okay, case study you can take your own time, read it, because if I read it, it will, you know, take a lot of your time. So I don't want to waste that time. Take your own sweet time, read it, and then we'll come to the answer. I straight away jumped to the answer. Through answer I will explain and you will be able to get the question. What was the question? Now there are some issues. These are the negative sides. Why? Because AAA's business model will not create value in the long term. Something is wrong with their business model. So we'll see what are the points. 1, 2, 3, 4, 5. So there are 5 drawbacks versus 3 positive sides. Okay, then there's a summary. Even the summary should be very small and brief, but here they have tried to include, I think, every point, which is not possible again, but we'll see. Okay, so straight away first we'll go to the positive side. Okay, if you see in terms of financial capital, it increased. Why? Because as a result of its profitable current business activity, their current business activity is profitable, that's why their financial capital is good. You always have to say why something is good or bad. You just cannot say financial capital increased or financial capital decreased. If so, also you cannot say financial capital is increased, that's why it's good. What is good for whom? No, you can't. You have to say because of the result of something, some activity must have taken place. Okay, that's why this has increased or decreased. That's how you need to explain. Okay, second, again they're talking about financial capital here. Okay, why it increased? One reason is profitable current business activities. Second reason, it could be due to the receipt of government grants. Maybe government have given them some grant. So because government has given them grant, it will help them to pay their debt, repay its debt in the short and medium term. Okay, two reasons you got. Third reason, positive impact on social capital. Social capital means you're talking about the population, basically low income, middle income, high income people. So they are helping the low income families to buy essential item of clothing. Basically this business is into clothing. Okay, if you want to understand what business it is a public limited company purchases shoes directly from manufacturer and then sells them through UK based shops. Okay, so basically they're selling shoes, is into the shoe sector. Okay, and from the case study, even though I have not read it full, you can see that they have written it has been profitable for many years. Okay, they are selling well among lower income people, and discount is because of government grants. So through this thing you can understand. Next, so they are helping the low income family by buying essential items of clothing. This is basically you are creating a brand loyalty from this customer. Okay, also you are generating a good publicity by doing it. So because of this, it will further increase your financial capital in future. You see, you should be able to link this with your capital. Now we are coming to the drawbacks. Okay, so okay, on one side you are saying government grant will increase your financial capital, but can you forever rely on it? No, you cannot rely on it. Why? Suddenly some year government will have budget cuts, then what? Or increasing competition, then what? Okay, as a result of ongoing quality issues with AA products. There could be so many things. Okay, next drawback, it's human capital. What is it? Then AA does not invest highly in human capital. That's why there are so many unskilled and untrained staff are there. Because with unskilled and untrained staff, you cannot create a brand loyalty. You are not. Okay? Because of this, company is going to face issue. Next, third, okay, again is about human capital, I think. Okay, they are using cheap labor from overseas. Now let's see what is the impact. You have to explain the impact basically. So even if you're using cheap labor, you might say in terms of finance, you are saving cost. It might increase your financial capital, but it may lead to net decrease in other capitals. Your other capitals will suffer. Remember, all the six capitals are interlinked, they're dependent on each other. If you're having a positive impact somewhere, it will be having a negative impact on somewhere else. It's always like that. Because it is cut from some other capital to get a gain in that capital. It's like that. Okay. So now AA may be criticized for not investing in local communities. Yes, you can be criticized. The drawback is that if you are using a cheap labor, you will be criticized by your communities. Okay. This will have an impact on your social and relationship capital also. This is another type of capital. If you are not investing in human capital, you see. Next thing is the AA's recognition of the need to increasingly monitor supplies indicates the current economic benefits may not be sustainable in the longer term. Okay, if you have to keep on monitoring your supplier all the time, you are unlikely to be a sustainable business in the long term. You should have that trust with your supplier that they will give you quality, that you're not exploiting them. So now, next drawback, carbon footprint. If you're purchasing any goods from overseas, currently double A is doing it. It will increase your carbon footprint. Okay. So and another addition to it is also it does not widely recycle also. That's another bad thing. Okay. So both of this will lead to a drain on natural capital. This is known as natural capital. Okay. Next drawback. So you see, through an integrated reporting, what's happening? I'm able to understand everything. The carbon footprint, to how much they're investing on the supplier, then what about their finance capital, what about the government grants, all this I can understand. Just looking at financial statements, I might not have been able to understand this, right? Can you understand now? Okay, coming to the next point. It's about the business model. So a focus on high street expansion, they are planning to expand on the high street, may leave them vulnerable to this online competitors who will be able to offer the same products more cheaply. You see, because you are focusing on high street expansion, meanwhile competitors will focus on the online, so they will get online customers more than you could. Rather, you could have expanded online, right? In this case, AS lack of investment in staff may compound this, because of retail stores are unlikely to offer great experience of level of service, because they are not currently investing in staff. This is also going to have an impact on your retail store. Why? You need good staff there. So this will have a decline in the experience that customers are going to get. So the current business model therefore may not be resilient in the medium or the long term. Current business model is not going to work in the current medium and the long term. What is that current business model? You are not working, you are trying to expand on the high street, you are purchasing from overseas, increasing carbon footprint, not even recycling, you are not investing in your, you are uh, what is it? You are using cheap labor from overseas, you are not training your employees, all those things. This is not a good sustainable business model. Maybe for short term, yes, you will save some cost here and there, but over the long term, it will not work. So now summary is, what is the summary? You can give your own summary to this. Summary is, currently, yes, currently their business model is profitable. How can you get it? From their historical financial statement. This information you will get about profit. But according to integrated reporting, what happens? It's a pessimistic outlook. Why? Because you can see it's not going to work in medium at all. And this is not good. Why? Because banks are going to invest in those countries that have a sustainable business model, not in your company. They are likely to invest. Okay. So therefore, integrated reporting. You see, the question was how integrated reporting will be useful. So integrated reporting will help them to make stronger investment decision. You see, now because of integrated reporting, they know they have to invest in recycling. They have to invest in human capital. They have to hire better staff who does not, a supplier who does not exploit child labor. Okay. Even other investors will get benefit from it. They can make more informed decisions. Okay. But understand, this is not mandatory. Integrated reporting is not mandatory. It is something voluntary. If you want, you do it. Okay. So business which have a detrimental net impact on capitals. Okay. That means those who have negative impact on the capitals are unlikely to produce this report. Why would they show something as a negative if it's negative, right? If it's positive, yes, definitely they will do it. Okay. But if it was mandatory, what happens? Imagine if integrated reporting was mandatory. Obviously, this part you might not have think about. You didn't even write about it. It's fine. If you write till this much, you'll get the marks. But let me explain, since it's given to you, I will explain you the point. Okay. If it was mandatory, it will motivate a company to shift its focus from short-term financial capital to increasing value in the other capitals, like investing in human capital, investing in your social capital, like that. Okay. That's it. Thank you for watching. And with this, I'll be Seeing you in the next lecture. That will be my last lecture for SBR, lecture 41. That will be on current issue. So make sure that you do questions, especially on this area, analysis and interpretation, because this is a little trigger, like a little, what would I say, difficult when it comes to answering this section of SBR syllabus compared to your IFRS or IA standard, because you have been doing it over and over again. But this type of questions are often not done. They are not practiced that much. Okay, this is also very important because I think your 25 marks is from this question, from analysis and interpretation. So make sure that you do it because it comes every year. Trust me. Questions on analysis and interpretation every year it comes. It could be from anywhere. Integrated reporting or additional performance measure or tech companies or cash flow, right? It could be from anywhere. You need to be prepared for all the sides. Okay, so thank you for watching and see you in the next lecture, last lecture.